Okay, buddy, welcome back to the Morning Edge webinar, and let's keep on going with the news and mixing up with the technicals. So bonds of Eurozone laggards quiver with ECB poised to trim QE. Eurozone debt markets on Friday gave a glimpse into what life could be like for the bloc's weakest states when the central bank starts to withdraw its monetary stimulus scheme next week. The yield, an indication of borrowing costs on bonds of southern Eurozone states, including Portugal, Italy, Spain, pushed higher on the final day of trading before the European Central Bank drops its monthly buying purchases from 80 billion to 60 billion euros. These weaker so-called peripheral states are seen as the most dependent on trillions of euros the ECB has spent over the last few years to shore up the growth and inflation. And as a tentative recovery gathers steam, some policymakers, including Dutch central bank head Klaas Knot, are calling for speedier so-called tapering of the scheme set to run until at least December. And we mentioned yesterday that Knot, had said, they can go and start to do that. He said, provided the data stays strong, although he, provided that caveat stating he doesn't see why it wouldn't. But the caveat was, he said, provided the data stays strong. The unwinding generally is a risk-off event, and for a lot of peripheral countries, it doesn't take a lot of terms of higher financing costs for their debt stock to look problematic. Rabobank strategist Lynn Graham Taylor said. The Rabobank estimates the gap between Italian and benchmark German yields, which already ran the widest in nearly 3 years, could stretch by another 85 basis points as the ECB withdraws its monetary stimulus. The first step is so-called scaling back of its government bond buying scheme that takes effect on Monday. And investors have become increasingly nervous about how quickly policymakers might tighten policy thereafter. Some officials have argued that the ECB could raise rates before it ends asset buys, a move that could be counter to its current guidance. But others have dismissed such a discussion. The ECB's tapering also comes at a time when the world's biggest economy, the United States, is tightening monetary conditions. New York Fed President William Dudley called for more rate hikes and eventual trimming of its bond portfolio. While benchmark German bond yields were little changed on Friday, low-rated bond yields rose. For Portuguese, Italian, and Spanish 10-year yields climbed 2 to 4 basis points higher to 3.99. The next 2 months will be threatening for longs. As U.S. data improves, political risk in Europe ebbs. Investors refocus on the progressive central bank exits from easy money, Societe Generale strategist Chirian O'Hagan said. Reuters revealed this week the ECB officials are wary of making any new changes to their policy message at their April meeting, and after small tweaks to the forward guidance this month, unsettled markets. That view was reinforced by weaker than expected Eurozone inflation data on Friday and comments from Executive Board member Benoit Kerr that ECB's policy guidance remains valid for now, but could change if inflation fundamentals warrant. In the last 2 weeks, Germany's 10-year yield, the block's benchmark, has swung from 14-month highs of 0.51 to a 1-month low of 0.32. A weak consumer spending data also rattled French bonds on Friday, added to its investors' nerves about the upcoming presidential election, where one of the leading candidates is far-right skeptic Marine Le Pen. Like I said, we could see a lot more volatility with the euro now. I guess people are kind of like, on the day of the FOMC, as I mentioned, Deutsche Bank, who had been looking for a below parity euro, had moved the call to 108 and potentially a squeeze to 110 by the end of the quarter. We got up there. We had seen some other banks wind down too, get a little bit bullish the euro. We did make that move, and we've run out of gas. So we can probably see some decent two-way action in the euro without it going in one particular direction for any long length of time. So as you can see here with the euro, we had one heck of a run on this market, and we've gone into a corrective mode. Now, we haven't turned bearish by any stretch, but we've definitely gone into corrective mode. But I think what you'll see going forward is a lot of dancing in and out of this market, coming to areas where it looked like a pretty decent buy area, but My guess is any moves up towards the 758, which is the old, the daily we talked about at 762, are going to be faded until this market can truly prove itself. So I think it's going to be a technicals traders type of market. Ron says, how can he find these twit longer posts? I just put them for the news. So it's on, but I don't, you know, I sometimes I'll post them on my regular feed, but the reason you don't see them because it's on a feed that I don't use very often, which is called the Inside Call. And then sometimes I'll go in and post them onto my regular feed. So it says, and one of the things I'll look at the one is because, like I said, it kind of plays into this whole, as we go into month end, the dollar's kind of gaining a little bit of the strength in here. So China's yuan slipped against the dollar on Friday as investors brace for a tense first meeting between U.S. President Donald Trump and Chinese President Xi Jinping next week. Faced with a sharp fall in the yuan last year, Beijing responded by imposing capital controls, and traders see only a small probability of persistent weakening of the currency given a recovering domestic economy and a tighter monetary policy. Activity in China's manufacturing sector unexpectedly expanded at the fastest pace in nearly 5 years in March, adding to evidence that the world's second largest economy has picked up momentum early this year. It's interesting, and like I said, on Fridays we kind of mix it up a little bit, and we're doing a little bit of the combination of the news with the technicals. It's interesting to note because when we read about the Aussie, we was talking about how it benefited from we had this stronger than expected Chinese PMI, which quite often the Aussie dollar trades as a proxy for what's going on in China. And when we look at this, we already know that the Aussie dollar a pretty decent run already. We saw this nice recovery. It's interesting that on that good China news, which was a surprise, that we didn't push even higher. Not a whole lot higher, but maybe up to this 61%. Up in here, maybe about 76, 87. It's interesting that the market instead chose to basically, to a certain extent, ignore unexpected good China news on its PMI, manufacturing PMI, which generally will get the Aussie dollar really clipping along, especially those who know from back in the day. So this whole idea that of the this whole idea of the RBA trying to clamp down on this housing boom that's been going on for well over close to now 3 years, and the whole idea that they're not going to do anything for a while is really, you can see how it's impacted the Aussie and how the Aussie's pushed weaker. Also, as I mentioned before, is you got to look at that with the dollar working higher, and you're seeing, obviously the best way I look at that is with the euro, which comprises 56% of the cash dollar index. Working lower, we're in a corrective mode, so you're seeing these currencies give back. Not a whole lot, but give back from these levels. So it's interesting to see that it couldn't add on. Anyway, let's get back into the news. Today's PMI offers more reason to be optimistic toward the economy, and that means room for further yuan depreciation could be limited, said a Shanghai-based trader at a foreign lender. Yeah, it's interesting, like I said, to see how the Chinese data, especially a PMI, and at that, a manufacturing PMI, would come out with good news, better than expected, and we wouldn't see the Aussie dollar necessarily react, which kind of shows you that the Aussie dollar might be, like I said, set up for maybe a further pullback on this news. But it's interesting to see we couldn't get a pop on that. In addition, the PBOC is gradually tightening liquidity conditions, which explicitly, well, without explicitly saying so. Traders also brushed aside the potential impact of U.S. policies on the yuan, said it's less likely that China will be labeled a currency manipulated by Washington. Trump has frequently accused China of keeping its currency artificially low against the dollar to make Chinese exports cheaper, keeping markets on edge ahead of Xi's meeting with Trump next week. Vice Foreign Minister Zhang Zhejuang said earlier on Friday that Beijing does not have any policy to devalue its currency to promote exports. So moving on, let's get over here to sterling. We've seen a pretty nice knockabout on sterling with this whole Brexit thing. People thinking once they had the news, it would actually weaken the sterling. It went higher, but then it turned around and kind of gave back those gains, and now we're trying to position back a little bit higher. So it's been basically all over the place. Says sterling slipped against the dollar on Friday as investors ready for the European Union's official response to Britain's letter of exit from the bloc, as well as the final verdict on Britain's economic output last year. EU Council President Donald Tusk will send leaders of the other 27 member states in its proposed negotiating guidelines for Brexit talks before presenting the main points in Malta, 2 days after the British Prime Minister Theresa May formally triggered the 2-year withdrawal process. Meanwhile, revisions to fourth quarter UK domestic product are expected at 8:30 GMT. Should already come out. One of the thoughts was when they came out and May gave her letter, we remember reading that it said the more important concern is going to be how the European leaders react. And I don't think they're going to let Britain off the hook too easily. Although, like I said, the sterling is working higher. I think it's a flip between this. Bears think that they got to go in one direction, and when they don't see the cover, they don't see the follow through, they start to go and cover. And I think it's just a mix of that for right now. Although I would agree that longer term, the cable will probably would remain under pressure, but we'll have to come into next week. Both events will be watched by investors as Britain gears up for what could be a tough period of political jousting with the European Union over terms of its exit. I think we can assume the initial EU response is going to imply the cost of divorce will need to be settled first, perhaps at least in principle, said Jeremy Stretch, as a realization that the first point of contention between the two sides, and then that might be a cautious reason to suggest that sterling may soften a little this morning. But actually, sterling is working higher, or the cable is working higher, I should say. Political uncertainty surrounding Brexit and signs the UK's economy is slowing as Britain enters a negotiating period with the EU have seen investors take net short positions on the pound versus the dollar to record highs. And while you're seeing this market easily, correct, and like I said, we'll go into the cable real quickly. So that we kind of mix this up with the news so we can see this being played out. And you can see here's the cable right on its highs right now. So, like I said, yes, there's a record number of short positions, but as we go into the weekend, month end, getting some of those people want to, just jump out. And so we're getting this mix of where we come down, then we rally back up, we come back down and think that everything's okay. They're rallying back up. It looks like now everything's going to start to slide and no follow through. So they're rallying back up. So I think probably a good reason why you're seeing, like they said, the record highs, you're seeing a lot of, two-way action, here on the cable. British housing prices fell in March for the first time since mid-2015, mortgage lender Nationwide said. And separate data showed British consumer morale steadied in March, but households remained downbeat about the outlook of the economy. Credit Agricole strategist said there was limited potential for a surprise in Friday's UK GDP numbers. In any case, such data is backward looking and will not have any major impact on monetary policy expectations and or the currency. We stay with the view that sterling is the sell on rallies within the last few months trading range, they wrote in a note to clients. Scottish First Minister Nicola Sturgeon has written to Prime Minister Theresa May formally demanding that she allow a second referendum to be held on Scottish independence ahead of the UK's exit from the European Union. Yeah, because one thing with the Scots, they've said they would prefer to stay in the European Union. So I guess that's their point, is that, hey, look, you're looking to pull out. We'd rather stay. So with that, we need to have a vote of self-determination. I guess you would have to refer to that as. But anyway, getting back here on the dollar edges up, but heads for the worst quarter in a year. The dollar is up on Friday and was on track for its strongest week in 7 with almost a 1% rise, benefiting from a weaker euro as solid U.S. economic data has contrasted with cooling Eurozone inflation. And we talked about how that was weighing on the euro because we started out at the beginning of the week and we had the great PMIs and the whole thought that the ECB may begin to adjust their stance, policy stance, and maybe we might even see it start to tighten before their QE ends. And now you get this inflation data coming in weaker. And as I mentioned, it kicked out one of the legs of the stool. And then, as I mentioned, you had the ECB governors, making comments yesterday saying, wait a minute, the market over or misinterpreted what we were trying to say. So, and then once you got the euro below that 762, and we said about that key level on the daily chart that opened it up for a corrective mode, which is what we're in right now. Anyway, getting back to this, it says over the quarter, though, the greenback has fallen 1.7% against a basket of major currencies. Its worst showing a year on doubts that U.S. President Donald Trump was not prioritizing and did not have the necessary power to push through Congress the economic reforms that had driven the dollar to 14-year highs at the start of the year. Revised U.S. gross domestic product data on Thursday showed that the U.S. fourth quarter growth slowed less than previously reported as consumer spending provided a boost that was partially offset by largest gains in imports in 2 years. In contrast, German and Spanish consumer price data disappointed on Thursday, showing inflation slowed more sharply than expected in March as oil prices slumped, offering some respite to the European Central Bank as it faces pressures to wind down on its monetary stimulus. The weak inflation numbers, along with ECB officials and sources, suggest that the market had moved too far in pricing the monetary tightening that have weighed on the euro, which has fallen to almost 2%. As I said, when they came out, that really weighed on the euro, gave an extra dip, but we were just below the lows. Then we got the Trump talk about the currency manipulators. We did move up higher in the euro, but we couldn't take out that 762, and that basically opened the door then for us to move higher. Later on Friday, Trump will sign executive orders aimed at identifying abuses that are causing massive U.S. trade deficits and clamping down on non-payment of anti-dumping and anti-subsidy duties on imports. Commerce Secretary Wilbur Ross told reporters that one of the orders directs his department and the U.S. Trade Representative to conduct a major review of the cause of U.S. trade deficits, including currency misalignment. But like I said, that's just, a review. That's all. We're not seeing any action. Okay, and that's one of the things that when people saw that headline, people got worked up. But once again, it's just, as I was saying yesterday, it was just, looked like it might just be bluster if there's no details, and there were no details. While the foreign exchange market's reaction to the news was muted, market participants were warily watching for developments. From a risk management perspective, it's definitely something on the radar, said Bart Wakabayashi, branch manager for State Street Bank and Trust in Tokyo. Okay, lastly, let's go look on the gold. I'll tell you what, I have not done too great on this gold. I'll tell you that. It's just been really hanging on. About the time I gave up on this doggone gold to go lower, then it turned lower. It was a lot easier to kind of pin the moves and what was happening in the euro. But I tell you what, this gold, I kept waiting for it to fall, and then we took one more stab up. Then it came back, popped up real quick, and just hung around. I got spooked out of my position and knocked out on the thoughts that, hey, wait a minute, we might get some month in or whatever, although it didn't seem like it would make much sense. But of course, then with the dollar strengthening, finally gold gave in. But unfortunately, I wasn't there for the ride, so it really, somewhat upsetting. But it is what it is. Those are the way things happen. It says gold prices will edge higher this year in the face of a persistent surplus of the physical metal. GFS analyst at Thomson Reuters said on Friday, as jitters over the U.S. and European political backdrop drive investors to bullion. Buying of gold as a safe haven plus a recovery in the Indian buying are likely to push prices to an average of $12.59. That area is right there where we have the 200-day moving average. We've gone over that several times this week. As the year progresses, safe haven flows become increasingly likely, assisted by either U.S. or European politics or a combination thereof. An anti-EU election result in one of the European nations could raise uncertainty over the prognosis for the euro, while an unorthodox approach from President Trump may bolster investment activity. The market are also jittery as to whether U.S. equities have gone too far, and gold is expected to benefit from risk aversion. That will likely support prices even in the face of persistent oversupply. The physical gold market surplus swelled to a 7-year high at 952 tons. Total physical demand fell 18% to 3559 tons, largely due to sharply lower jewelry fabrication. Gold jewelry consumption slid by a fifth to a 7-year low. Of the two biggest physical gold markets, Indian jewelry fabrication fell 38%, due in part to the introduction of excise duty on jewelry manufacturing, while Chinese fabrication slid 17%. You would think that these bits of data would, or ancillary data to a certain extent, would weaken our gold. Yeah, it's weakened now, but it held up for so long. Let's go on and move into the charts and get our bias chart ready. As I said, on Fridays, we like to spend a little bit of extra time, kind of like a recap of the week and what we think may or may not happen for the week ahead. Let me see where the heck the, oh, there's a bias chart. Hang on. So we had our support yesterday at 696, and we got that dip down here, and we were looking potentially for a corrective mode. Just to go on and recap again, we'll go into the Euro daily chart that we've been covering since the middle of last week, and we've talked about the significance of this 762 and how the market, pull this up here, how we got up to the 762. Remember, I had it just with the touches going across. I never do, as I said before, I never put my trend lines at the bottom tick, the top tick, because who bought the bottom tick and who bought the bottom tick and who really cares? I go with the most of the touches, which I guess for some people, which I'm not a volume analysis guy, but that makes sense with the volume, I guess. But I go with the touches. So that's why the significance of the 762, you can see where we closed there. And then on that day, we couldn't get it above it. It opened the door for lower. We didn't get much of a follow through on the lower. So we rallied up, and we can see how that 762 was well defended. And we got the gap on Friday. But we couldn't get that extra follow through. We covered that on the 2-hour chart and how the 762 was being sought as support on the way down. Once we got this leg lower yesterday, and then with the weaker Eurozone inflation data, and then the ECB governor saying, hey, hold your horses, we're not talking about raising anytime soon, then it really pushed us lower. And then, as I mentioned before, is the when Trump made the currency manipulator comments, the key was the market could not get above the 762. Once again, just to go on and recap that before we move in there, we detailed yesterday. Here's the Eurozone inflation data. We're here at the 762. Eurozone inflation data comes in weaker, so we just start treading lower. Get a little bit of a bounce, but the market's still relatively weak. The ECB governors come out and say, hey, wait a minute, hold your horses. So we take new lows, no big deal. We're just kind of stuck in this area. The Trump currency manipulator comments come out that allows the euro to move higher, but look, it can't take out that 762, and that's that daily chart, how it's critical. So that opens the door for us to head lower. And we said that if we get a below 762 on a daily chart, that puts us into a corrective mode. Doesn't turn the euro bearish, but puts us in a corrective mode overall. So let's go on and get into the 2-hour chart. Where are we looking at today? Well, the 648 presents a pretty decent level, and 652 is a 61% right in here. But you can see coming across here, you see a lot of good touches. It's the 630. I don't know that we'll make it all the way to 630. And the thought you have to have is we're coming into month end. These people that got long here, and we talked about looking for bigger moves and stuff, some of them took the money off the table. Some of these people, if they push too much lower, below 650, they'll probably end up getting stopped out and say, you know what, I'll just get out of my longs here. So I think the risk is to 630. I don't really necessarily think it could go to 630. So we'll put today's support. Got 648, 652. Let's see if we can take a look at a 30-minute to see if we can find something in the middle there. Okay, 641. We'll go with the 641 here. I think the pressure is going to remain on the euro because as we go into quarter end, I think people are hesitant to take any positions at this point and would rather come in on a Monday. Um, so I think the onus is to the downside, but where are some good areas? So let's also take a look on the upside. We have 710 here, but if you remember on the 30-minute, we're going to come back and revisit the 30-minute. And that'll be the top of the zone, which is 714. We're going to go with that. Now we do have 710 on the euro on the 2-hour chart, but we got up to about 697 or so this morning, so I think we'd be able to get a little bit higher. It doesn't mean it would make it all the way to 714, but I think you have to go and list that as your resistance. So it's time for a break. When we get back, we'll go on and cover the rest of the markets. And thanks for joining us here on the Morning Edge webinar.